Hi, Matan Feldman here from Wall Street Prep. Today we are going to talk about EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It is perhaps the most important and to some extent controversial measure of accounting profit. Before we dive into this lesson, let's actually just go into the real world and see what EBITDA is for a company that we're probably all familiar with. So we're going to go in and we're going to look for Apple's EBITDA. What is the profit in EBITDA terms that Apple has generated? So we're going to go to Apple's investor relations section of their website. We're going to go into their SEC filings. We're going to look at their last 10K, their annual report from 2022. So let's go take a look. Let's look at their annual filings. And what I want to do is I want to open up their PDF. It will be easier to navigate. And this is the filing that Apple reports at the end of 2022. We're going to scroll down to their financials. In that income statement, what you see is that Apple has generated sales of nearly $400 billion. That's a lot. And they've got gross profits of $170 billion. So a little less than 50% profit margins. Pretty incredible for a business like Apple. And then they have, research and development, selling costs, a whole bunch of stuff. That takes another $50 billion out from their gross profits, and then their operating income is $119 billion. Okay, now if you go a little bit below that, they've got a whole bunch of other stuff that's not really tied to their core operations. You have things like interest expense that is buried in here. They got to pay interest on their debt, although not quite a lot, and they've also got a lot of cash on their balance sheet, so they got interest income generated. But then they got to pay taxes. They pay about $19 billion in taxes from an accounting perspective, from an accrual accounting perspective. And that gets you to their net income, about $100 billion in 2022. So notice one interesting thing, you get down to EPS, earnings per share of $6.11. Nowhere in here do I see anything called EBITDA, and this lesson's about EBITDA. So what gives? Well, it's actually the first part of the lesson of EBITDA is that it is not a sanctioned accounting term. You will not see EBITDA on a company's income statement typically, certainly not the ones that are filed with the SEC in an annual report. Although interestingly, if I go in and I Google Apple 2022 EBITDA, you'll immediately find services that that try to calculate it. And this one says here, it's $130.54 billion. So what's happening? Before we dive into the calculation of how you get from here, they've generated profit, net income of $100 billion on nearly $400 billion in revenue. Well, where's this EBITDA coming from? It's not exactly their operating income. It's not exactly their earnings per share. What gives? How do you get there? Well, so let's go back to our lesson and remember that the actual definition of earnings before interest, taxes, depreciation, amortization, you can look at it as a formula that starts with EBIT plus depreciation plus amortization. Well, what's EBIT? Earnings before interest and taxes. The closest equivalent to that term, again, this is a non-GAAP term. It's not a generally accepted accounting principle term. But the closest thing to it, what it really represents is earnings, how much you've earned before interest and taxes. Well, what's the closest thing to that here? Well, here is your earnings before interest and before your taxes. This is your operating income. These two terms are used interchangeably. There's some nuances there, but certainly for the way Apple reports, which is really nice and clean, those two terms are identical. So operating income is your EBIT in the story. Well, if you want to go back and add depreciation and amortization back out of it and basically say, well, what will my profits be? In other words, what is EBITDA? You got to basically ignore any depreciation and amortization the companies recognize. Well, I don't see any depreciation and amortization here. And that's because companies will embed depreciation expenses, which are non-cash. They'll embed them into these other expense categories. And the only way to really identify what those are is actually scroll down typically to the cash flow statement, which is usually a few pages later. And it'll say, actually, those expenses that are non-cash and are embedded in those other expense categories for Apple is actually $11 billion. And so now you're starting to get a sense, okay, well, if I wanted to add that stuff back, I'm getting something close to $119 billion in operating profit plus that $11 billion. Let's actually open up Excel. I'm going to slide Excel in here. All right. So I'm going to take, since I'm already on this page, might as well use it. Here's my depreciation and amortization. and that is 11,104, and then I've got my EBIT, or operating income, which is the correct GAAP term, and that was 119 billion or so. So let's grab that. There it is. Let's make sure I'm getting it from the right spot. Operating income. Let's drop it in there. And now my EBITDA for Apple is 130.5 billion, and that exactly matches that 130.5 billion that you're going to see kind of in the news. So let's get back to our lesson. So now that we kind of looked at it and we said, all right, this is how you calculate it, let's just talk a little bit about why it matters, what it's all about. Notice, by the way, that EBITDA is actually, you can look at it a bunch of different ways. The actual definition is earnings before interest, taxes, depreciation, amortization. That's kind of the process we went through. But there's kind of another way to look at it, which is top down. What's Apple's total revenue minus the cost of goods sold that excludes depreciation, amortization expenses, and operating expenses that exclude depreciation, amortization. The other way to do it is start at the very bottom. Start with net income and then add back taxes, interest, depreciation, amortization. So if you go back to this financial statement, you can kind of see that if you think about profits as basically this waterfall from sales all the way down to net income, or earnings, again, a term that's used interchangeably, well, and you know that, hey, buried within these expense categories are depreciation and amortization expenses, which, by the way, sometimes companies don't exactly tell you where they're burying them, but we kind of know that these are operating expenses. Depreciation and amortization under GAAP are recognized as operating expenses, so they're buried within these operating expense categories. We don't know exactly how they're allocated. Most companies will not disclose exactly how they're allocated, although some do. But the main point is, so that means you can start the way the formula really starts, which is EBIT plus D&A, add it back, or you can start with operating with net income, add back taxes, interest, and go back, or you can start from the top down and subtract only the stuff that's not, only the expenses that are not depreciation and amortization. Hopefully you get the idea. There's a whole bunch of different ways to get at the same number, but this number is this measure of profit. It's not exactly accounting operating profit. It's a little bigger than that because it excludes non-cash expenses like depreciation and amortization. That's the idea. So what's the conceptual meaning of EBITDA? So here we've got a statement that really kind of describes it. So I'm just going to highlight this here in yellow. The conceptual meaning of EBITDA can be best described as the normalized, we'll talk about what that means, the normalized operating earnings generated by a company's core business activities. I'm going to extra highlight a couple of terms here, core and normalized, while neglecting non-operating items like interest expense and taxes. Okay, so we kind of saw that with Apple, didn't we? Which is operating earnings is like that operating income line, but we excluded depreciation and amortization because we want to look at a company's profits without this giant non-cash expense that can legitimately skew the picture of what's going on from an operating perspective. This is where it gets controversial. If you ask Warren Buffett, he's going to say EBITDA is silliness. It's a way to inflate profits by excluding depreciation and amortization, these expenses that are real expenses. Now, they may not be cash in the sense that accounting wants you to recognize historical purchases of equipment today through depreciation. Well, you're ignoring actual cash expenditures through CapEx. So you're really ignoring required investments to run the business, will be Warren Buffett's point. But most of the world, especially in mergers and acquisitions, when you're thinking about what is the value of a business, the multiple that's ascribed to that business often tends to be a multiple of EBITDA. So to some extent, while everybody loves Warren Buffett, the reality of it is most of M&A is done implicitly ignoring that admonition, where everyone sort of looks at EBITDA and says, okay, well, that's the best measure of profit because it excludes this giant non-cash part of the expense category. The other piece here that I highlighted, magnified, is that it's really focused on operations, right? The easiest way to think about this is with that Apple income statement. Going back here, I'm just going to keep going back because I think everyone understands Apple. Apple sells a whole bunch of iPhones and iPads, etc. It costs them, direct cost of manufacturing those and creating those is right here. And so, their gross profit's $170 billion. Well, buried within here is a little bit of depreciation expense for equipment that's used to manufacture this stuff. Buried in here is a whole bunch of amortization. So this research and development is the cost of engineers, the cost of sales, general administrators, the cost of marketers. Well, buried within that is also amortization expense of intangible assets that it owns, etc. We go down to that operating profit, and so that's $119 billion. That D&A in there was depreciation and amortization was about $11 billion buried all in there. So the profit, the EBITDA profit we're saying is $130 billion. But then notice that when we say core, well, what does that mean? There's a whole bunch of other expenses here, but they're not considered sort of core to the operations of the business. Taxes and interest expense and interest income payments, both expenses and income related to financing activities, they're sort of considered not core. And the reason is, if you think about it from the perspective of someone who's looking at it as, what is the core operating value of this business? Forget how much debt it has on its books. Forget how much cash is sitting on the balance sheet. And forget what tax jurisdiction it's in. I really just want a pure operating measure of profit. That's why we talk about it as core, right? Core operating business activities. So that, in a nutshell, is EBITDA and the rationale for it. So if we scroll down, there's a lot of verbiage in this lesson, but we've kind of honed in on the pros and cons of EBITDA, or the controversies around EBITDA in finance. And so the big criticism we alluded to in EBITDA is the lack of consideration towards capital expenditures, or the sort of cash payments for equipment. Notice, by the way, what do I mean by that? If you're ignoring depreciation expense, which is the accrual accounting, GAAP accounting's way of accounting for spending on machinery and intangible assets, you've completely ignored it, right? And you're not taking anything out on the cash flow side, right? On the cash flow side is when you sort of recognize, if you go to Apple's cash flow statement, you see that they add back depreciation and amortization to net income. But during this period, they actually did have to spend money on property, plant, equipment. They did buy certain intangible assets, right? So they're factoring that in on the cash flow statement. It's just not getting factored in anywhere at all in the calculation of EBIT, right? This is accrual accounting. The cash flow statement is cash accounting. And so that's really the big criticism. For most companies, or I wouldn't say maybe most, but I'd say for many companies, CapEx is a major recurring cash outflow. And it's like one or the other. Either you recognize that the way the accountants want you to through depreciation, or you recognize it by taking out the capital expenditure charge for the last 12 months or for the current period. But the criticism is EBITDA does neither. It just ignores capital spending. Some other criticisms around EBITDA is that it doesn't really factor in changes in net working capital, and this is where we've got an entire other lesson about this, that EBITDA is not supposed to be a measure of cash flow, right? Changing net working capital, the fact that it doesn't really reflect, it's ignored in EBITDA, is not necessarily a legitimate criticism of EBITDA, because if you want to know what's going on with changes in net working capital, well, you're just trying to get cash flows. That's not what EBITDA is. EBITDA, here, this is where if you go into Apple's cash flow statement, you're going to see changes in working capital right here. If you want to figure out what Apple's cash flow was, here it is. Apple generated $122 billion in operating cash flows. It also pumped $22 billion worth of those cash flows back into the business by buying property, plant, and equipment, and a bunch of other things. And so really the net cash flows it generated was about $100 billion. If that's what you want to know, accountants will give you that information in a totally different financial statement. EBITDA is something a little different. For Apple, it's a little different. For some companies, it actually gets a lot different, and that's where some of the criticisms are, because EBITDA is a little manipulatable because it's based on some assumptions about what the useful life is of depreciation, etc. But let's just go back to it. So EBITDA tries to kind of live in both worlds. It tries to be an accrual measure of profit with this big non-cash charge removed. It's sort of a hybrid between accrual accounting and cash flow analysis. And that's really where it lives. It's why everyone uses it, because it's this sort of, it takes the biggest non-cash item out of accrual, but that's what makes it fundamentally flawed as well. So that's the story, and really that's the kind of lesson here. So I'll wrap up with a couple of other points. What is a good EBITDA? There's no real answer to that other than there are sector benchmarks. And so if EBITDA is the kind of main measure of profitability for a business, quite often investors think about a business in terms of its EBITDA margins. For example, Apple's business generates 40% EBITDA margins, right? If you look at that EBITDA of 130 billion, which you won't see on the income statement, but you can compare it to that 400 billion in revenue. We can bring back our Excel, and you'll see if you take revenue, you get EBITDA margin of actually about 33%, not 40%. And so that's an important measure of margin and profitability. A couple of other things in terms of EBITDA forecasting, but we'll leave the meat of this for the next lesson, is how do you forecast EBITDA? There are really two approaches to forecasting EBITDA when businesses think about forecasting it. They can look at it by thinking about, what's my revenue going to be? What are my expenses going to be? And backing into the profits, that's top down. The alternative is you start with your profits and work your way up. So those are two kind of mechanical approaches to it. So that is it for our lesson. If you want to use a template, I've started filling out some with a little bit more details and more examples to get the point across. You can fill that in. We'll make that template available in the comment section of this video. Hope you enjoyed this lesson.